Hi, let's cover my Elliott Wave analysis on Bitcoin on the 1 hour time frame. And in this video, I will explain why the probabilities are highest to still take out this high and as a bare minimum continue this range for a longer period of time. Starting with the first scenario, which is a WXY double zigzag. It's a larger three-wave corrective structure to the upside, and once finished, you look for price to move down and create another low. A WXY double zigzag has internally a zigzag in a W and a wave Y, so ABC zigzag in W, then you have wave X, and then another ABC zigzag in a wave Y. The invalidation for this scenario is price moving to the downside, taking out this low at 85.2K before taking out this high at about 89.2K. You can see that wave X here finished before this vertical line on the chart, and this vertical line is a Fibonacci time comparing wave X with wave W in time. Preferably, wave X would finish after the 0.382 Fib time. However, time is not an invalidation nor a strict confirmation, it just helps assessing probabilities of wave structures, and because it is not an invalidation, we keep this scenario on the chart because it is possible for wave X's to be shorter than the 0.382, it's quite simply less common. So we still keep an eye on it, and in this case, you quite simply here want a three-wave structure to the downside in a wave B, so a move down, move up, move down, then go back up, preferably takes out this high here, continue the range a bit longer, and then price moving up to take out this higher high here, the end of your wave A in this particular scenario, to then work on wave C of wave Y into areas of resistance that I will show later. Now the second scenario has a similar conclusion. You move towards the upside. The directional bias is the same. It's just that the subwave count is different because wave X is different here. So here we have again a WXY, but now we end wave X after this vertical line. So now wave X is finishing after the 0.382 Fib time. And we can do this by labeling this either as a flat AB and look for a wave C to the downside. So 1, 2, and then 3, 4, 5, meaning we don't want price to move above this lower high here at 86.5K. If price moves towards the upside and takes out this high, a wave C to the downside is invalidated and this becomes a three-wave structure, which is a possibility in a WXY. So the WXY would be then here A, B, and C. This is an ending diagonal in that particular case for a wave W, so we have a flat here. Then this move up has to be a three-wave structure, which on the lower time frames has to then be counted as a wave A to the upside, a wave B, and then 1, 2, 3, 4, 5. If we want to count this as a three-waver, sure, it does look like a five-wave structure over here towards the upside, but we have to be open to possibilities where wave X is longer than the 0.382, and the only way to do it is to count this as a corrective structure. So we just put an X or a B on top of this leg, and then this move down is either a Y or a C. But then again, the directional bias doesn't change, as after a wave Y or C, you finish X and you look for another leg towards the upside, which is your wave Y in a double zigzag structure. So we have a W, a larger X, and then eventually a wave Y. And if we count a WXY in X, then it's flat X, zigzag here, and then you move towards the upside basically. Now after a wave Y again, you look for price to move towards the downside. It is possible that if wave X would be deep, if this turns into a 1, 2, 1, 2, 3, 4, 5, 4, 5 for a flat and an A, B, and a wave C, if wave X goes deep enough and touches the 0.7 Fibonacci, which you take from the start to the end of wave W, the probabilities increase for a more sideways corrective structure, after which you look for move towards the downside. So we then have a W, you get a deeper X, you get another Y, and then price moves down. And wave Y does not need, in a sideways WXY, wave Y does not need to take out any of these highs here, right? Wave Y can just create a lower high and then move towards the downside. In a double zigzag, that's not allowed, as in a double zigzag, we want price to take out the highs here and move towards the upside, but in a more sideways WXY, wave Y does not need to take out the high, but you're looking for a larger corrective structure. Which is why at the beginning of the video I said probabilities are highest to take out this high / look for a larger corrective structure, and then we can assess at a later stage what we are dealing with and when a potential structure is ending. Now, the most bullish scenario is a multi-1-2. Not the highest probabilities, but it is the most bullish scenario and actually also the only bullish scenario. Because if we consider other bullish scenarios, then we have to consider an impulse, 1, 2, 3, 4, 5. But wave 4 overlapped with wave 1, which is an invalidation for an impulse. Sure, this is a bit of a wick into these highs, but pretty much all of the charts have this move towards the downside, this wick here, into these highs. So an impulse to the upside, 1, 2, 3, 4, 5 would then be invalidated. And a diagonal to the upside here would be an expanding diagonal structure. You can take a channel from this high to this high, which is then 1, 2, 3. So from the end of 1, end of 3 to the end of 2, you can see that wave 4 moved below the channel, which therefore means a contracting diagonal is invalidated. An expanding diagonal would be your only option, but an expanding diagonal is very rare. It's never preferred unless everything else fails, which basically means your bullish scenario becomes a multi-1-2, 1-2, 1-2, 1-2, and up in a larger wave 3. Guess what? The directional bias is the same. You're looking for price to still create a leg to the upside. But in this case, you're looking for a wave 3 to the upside. So you want price to really extend to higher prices, increasing volume, and you want price to really curve more vertical as well as volume is increasing. The problem though, and that's what impacts the probabilities, is that this second wave 1, which is a lower degree wave 1 compared to the higher degree wave 1 here, is 3 times the size in time compared to your higher degree wave 1, which is what the vertical line represents. It's a fib time taken from the start to the end of 1 to the end of 2. And you can see that this wave 1 ended around the 3 fib time, meaning it's very long in time compared to your higher degree wave 1. And preferably when we are looking at degrees and the multiple 1-2s in a multi-1-2 scenario, preferably the lower degree 1-2. So this is your highest degree. This is one lower degree. This is currently the lowest degree. Preferably, each lower degree is either a little bit shorter in time and price or quite equal in time and price compared to your higher degree 1-2, which is obviously not the case as this move up is basically 3 times the size. So that is not ideal in this particular scenario, but we can be aware of it. It's pretty much the only bullish scenario that makes sense except for an expanding diagonal, but that again is a rare structure. So this then in a nutshell summarizes the options, which means that it is interesting to look for areas of support and potential buying opportunities to look for another leg towards the upside. Either have something going on over here, and to be honest, I don't really have great support here. I'll show in a second what I got going on. We either look for a larger wave X or we have the multi-1-2. Now, if we zoom into the 50-minute time frame shortly, then you can see the K16 Principle. This is one of the methodologies that I have in the Kuhn's theory playbook, basically. It's about directional bias, which we publish later, either this year or early next year. But you see a move to the downside, a move up, and a move towards the downside. If you if you take the 1.618 from this low to this high, and price moves down and touches the 1.618, then this move to the downside from an Elliott wave point of view is a low probability wave B or X to continue this range in either A, B, C or WXY. Probabilities are higher. This is a separate structure. So you're looking for a move down, move up, move down. Touch the 1.618. If price can now move to the upside without a range here and another low, if price can move towards the upside here and take out this high at 88.5K, it pretty much confirms a 3-wave structure to the downside, which therefore increases probabilities to take out this high. And that is interesting because if price moves up, takes out this high and preferably continues the range a little bit longer, then this move down can move into areas of support. For example, we can take a volume profile then, and then if we get this move towards the upside, but possibly your point of control is going to be this value area low here, so we extend this, which can then be a potential opportunity to look for price to move towards the upside. Because the bias is going to be bullish, as then we're looking for price to take out that high. But note, it has to be a 3-wave structure down, not like a 5-wave looking structure. So preferably you're not going to range here sideways and then take out the low, as that would basically invalidate the K16 principle. You want a 3-wave structure to the downside, down, up, and a move towards the downside. and then eventually turn around to take out that high. Having a very short move here and then a move down is no problem. You just don't want it to be too long. If we then look at my levels, areas of support and resistance, I quickly zoom out and I open my volume levels here. So you can see the volume levels. These are my favorite levels. And if I zoom in, you can see this white box on my chart here. This white box here sitting between 86.9 and 86.5K. Now this box does not represent any of my more like significant levels that I have on my chart. However, when I pulled a couple of volume profiles this morning, you can see that a few things add up. So we take the volume profile, and let me first take the volume profile here. You can see a point of control. Then a volume profile from the low to where price is now. You can see a value area high. These are the boundaries of the box. And if you then take another volume profile of this structure over here, then you can see that there's another point of control in this box over here. So these three levels basically are included in this white box. So I have to pull a couple of volume profiles to get this area on my chart. It is an area of support, but what I would prefer to see really is just like, first of all, we can see how price is reacting to this support, but it's still very, very young over here, right? Not too much has happened. What I would ideally see is price just moves up, takes out this high, continues to range a little bit longer for potential opportunities, then look for price to move up to take out the higher high. So the K16 principle, basically, as this is not one of my main levels. I just put a box there because a few volume profile levels lined up. But if I look at like the main levels, then yeah, well, you can see them on my chart and I don't really have something going on there, but I am aware there is something, but preferably I would see the K16 principle. These are time frame horizontals here on my chart. Then we have order blocks here on my chart to the upside mainly and one to the downside all the way down here below 30K. And then we have the aware zones. These are relevant for more like weekly time frame analysis. So let me switch to the weekly time frame. And you can see here that the resistance held very, very nicely. And then these are areas of support based on the KRC method, which is a bunch of fibs that I use. Then we get to the news. So this week over here, we have some news today at 2:30 p.m. Make sure you trade safe as it can increase the volatility on the chart. And then also on Wednesday here, November 26th, we also have some news, high impact news here. So if I open medium, you can see the list is longer. If I open low, it's even longer. But we're not interested in low and medium, only in high. And there we go, 2:30 p.m. Central European time today and tomorrow. Interesting. Keep an eye on the chart because volatility may increase. And then we get to the conclusion, which is actually quite simple. So locally, because this is a 1 hour time frame video, not the daily, not the weekly, just on a 1 hour time frame here, the probabilities of this structure here to the upside so far are higher for this to be a corrective structure, so a WXY structure, compared to this being a bullish structure. An impulse to the upside, 1, 2, 3, 4, 5 is invalidated with the overlap. A diagonal would be expanding, always low probabilities. And then your other bullish option is a multi-1-2, which is the one that's remaining. But the second wave 1 is 3 times longer than the first wave 1. Not an invalidation, but it does impact the probabilities. Probabilities would be higher. You got a 3 to the upside here, and you're looking at some WXY. So probabilities remain higher for corrective structure to the upside, but the directional bias of every scenario is the same. One looks for more upside to take out the high or at least create another move up for a larger range. So either do this and you don't take out this low, and if price moves to supports lower, you would still expect price to continue this range for a longer period of time before it really would continue the trend on a lower time or on a higher time frame, because on a higher time frame we still have an impulse to the downside. See the video of yesterday where I covered a weekly time frame, daily time frame as well. But on a higher time frame, if this is corrective to the upside, you're eventually looking for price to move towards the downside. So the bulls really need the 1-2 to play out, the multi-1-2, in order to flip those daily time frame probabilities. And that means the bulls need price to move to 97.2K, which is up here. If that happens, good for the bulls, right? But that basically requires a multi-1-2 here. Nonetheless, though, with regards to the scenarios, we don't really have to say which scenario has the highest probabilities individually, because the directional bias for the different scenarios is the same. You're just looking for another leg towards the upside, ABC and a wave Y. If you get a larger WXY and you don't take out this low, you move towards the upside. If you do take the low, no problem. You still look for another leg towards the upside anyway. You just have to keep an eye on lower areas of support. And in a multi 1-2, you just move towards the upside, no? Like you don't want price to take out this low, that's for sure. So the directional bias is the same. Now keep an eye on the K16 principle locally, can be interesting for sure if price moves up and takes out 88.4K, and then that's basically it for today's update. So thanks for watching this video. I hope this video was helpful or valuable to you. On the left you see a video on the simplest way to use and trade Elliott waves without even counting, and on the right is the Elliott Wave educational playlist to help you understand more about Elliott waves. Thanks for watching and subscribing, and I hope to see you at the next one. Bye bye.